taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the Total Money Management Podcast. We're going over the week that was September 19 to 13. Are we doing, gentlemen?
19 to 13.
9 to 13.
We're going back in time this week, people.
Early mistake.
Haven't had my fifth coffee.
Can someone explain something to me on the first page? There's a quote down the bottom from William
At the top.
Gilmore Sims. Well, yeah, but it's at the top too.
Look at that.
What's going on there?
It's amazing when you copy and paste something, isn't it?
Steve put a joke in.
But did you do that? I didn't.
No.
Or might have been.
Magic.
Anyway, the quote is, I believe that economists put decimal points in their forecasts to show they have a sense of humour.
Ha 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 ha.
We
So one
love
for the
throwing
old
off
boys there.
love throwing off at economists.
Funny.
Let's get on the big issues.
Righto.
It's been a quiet week. Not much happened in terms of the markets in this week, but there was the first debate between Kamala Harris and Mr. D. Trump. And like I watched it. I watched a lot of it. Harris seemed to have the more logical side, and therefore win.
Donald seemed a little untethered.
Donald was a bit off with the fairies.
They're eating the cats. They're eating the dogs. They're eating the pets.
I want to get a shirt made.
Jesus. Modern day America.
They're eating the dogs
honestly.
in Springfield.
But seriously, imagine getting on national TV and going, they're eating the pets. And it's like, oh, please.
It's the same guy who was arguing about his handicap.
The man can hit a bomb, though.
Yes. He knows what he's doing.
Yeah.
But it's just wild, isn't it? I mean, I'm sure probably you guys more than me are going to be looking back in 20 years going, what was going on there? I mean, that's,
mate, what's terrifying me is if this is happening now, in 20 years, we're all fucked.
Why?
Imagine what it's going to be like in 20 years.
No, it'll be better. We're near the bottom.
It's the clowns.
We're near the bottom.
It'll be better. That's what they said 20 years ago.
Well, yeah, good point. But if you read about the broader cycles, historically, they go for about 40 to 50 years. And we've had neoliberalism since about 1980, right? And that's why after 45 years, you're seeing the inherent problems come out in it, which is huge amounts of inequality, right? And that's what's driving a lot of the problems, right? That's why Trump was able to speak to the guys in the South who were disaffected factory workers who had a job at, the Ford Motor Company. I shouldn't use Ford, but had, Westinghouse. And then Westinghouse said, listen, we're getting out of, Massachusetts or wherever, and we're moving to China. All you guys have sacked. And then those guys had to then try and find another job. And you have to remember, Tom, back in those days, unions were strong. The factory operated, fairly harmoniously. There were strikes, a lot more strikes, but generally things kept going along, but workers were paid quite well. And so everybody could afford a house, a mortgage, raise 2, 3, 4 kids, right? You could buy a new washing machine and there were new cars coming out and it was all, life was pretty good. Then when they got the oil shock in the early 70s, that really blew America out of the water because America had big cars, right? Gas-guzzling cars because they were cheap. Oil was cheap. And when the oil price went from $3 to $40, right, that's a 10 timeser, right? That's when it created all sorts of inflation because oil goes into everything, right? All your plastics are all oil, right? All transport was all oil, right? All of this stuff. And so when they liberalised the economy by deregulation, moving everything overseas. The Japanese were, huge in manufacturing because the Japanese were smart and said, we're going to make little cars, right? And, of course, little cars use what? They use less petrol, right? So that was where the working class in America really struggled. And I remember reading about it, middle managers at the factory were then working at McDonald's, right? Guys, 55, had gone from being a foreman at a factory who, was a pretty sort of serious job to working in McDonald's and the
as a second job.
Well, No. That was their first job,
You're
right? Because they lost their factory job. And the old joke was, do you want fries with that? Right? Because it was then about saying, my dad's no longer a foreman. He's now working at McDonald's for $7 an hour. It was, look, I can tell you, it was a really, really ugly time. And companies would come out and say, we're going to downsize, we're going to sack 500 people. And the stock price would go from, $12 to $15. And people would go, what's going on? That's ridiculous. But you see, it was then about the profits were going to go to the company and the shareholders. So what do? Buy shares. Well, if you just got the sack, you haven't got the money to buy shares. So again, it was really cut and thrust there for for a lot of the middle class. So the middle, some of them did all right, as in they moved up, but there was quite a cohort of them who fell from being middle class into the poverty class.
Difference between the haves and the have-nots.
Absolutely.
Yeah.
Absolutely. And so that's, that's been growing to the point where it's so strained now. You get to the point where you go, well, listen, we can't cut wages anymore, all of this stuff where they've got to change the system. And that's where Trump came in and said, I'll look after you guys, right? They went...
The billionaire.
Well, yeah, I know, but you see, they went, Hillary Clinton never even visited those places, right? She called them deplorables. So what she was saying was, you people are deplorable, but, you're going to vote for me anyway, so I don't care.
Yeah.
And they went, you know what? No, we're not. We're going to vote for Donald Trump. Now, she still got more votes, but because of their electoral system, Trump won.
Yeah.
But it's still that thing where, like you say, Jacob, you go, well, how's a billionaire look after the working class, right? Because he appealed to them. Because the Democrats just ignored them. Oh, well, all those jobs are going to China. Oh, well, off to Macca's you go, So that at some point, those rusted-on voters go, you know what? It's time I change my vote.
Mm-hmm. There's been high levels of inequality for hundreds and hundreds of years, though. Like, it reminds me of the 1920s, like pre-war, where you've got everyone in fancy suits having these enormous parties, and then you've got across the road just poverty.
Yeah. Well, John Kenneth Galbraith said, I think he wrote a book. I can't remember if it was the title of the book. I don't think it was, but it was in one of the first books of his that I read, The Affluent Society. And he said, what you see a lot of in America is private affluence and public squalor. And what he was saying was, you see people like Jeff Bezos who, can get whatever they want, and then you walk outside and the streets are full of homeless people.
Mm-hmm.
Right? And Bezos drives past in a limo or flies over in a helicopter or something. But he's making that contrast of saying, there's a lot of private wealth held by the top 1 to 10%, and the bottom 50%, they own like 3% of the wealth, right? Which is, bugger all. And that's what I'm saying. Before, it wasn't that bad. Right, the boss earned more money, but in those, like in the 80s, before the 80s, in the 70s, the income difference was an employer, the boss, was generally had an income 8 times the average salary of an employee.
Bosses and CEO.
Yeah, now it's something like 350. Right? And that's why you get the CEOs now earning, 45 million, 50, 100, 200 million in America, plus bonuses that kick in at 500 million. Right? That's what I mean. We've gone from that where we used to be more like Japan, or America used to be more like Japan. So did we, actually. In Japan, the big CEOs, they don't get that much money, right? Because they look at that and go, well, that's not really good. That's not the way we operate. Whereas in America, it's like, yep, hey, if you can make 150 million, all power to you.
Well, it forces people to make decisions that they might not naturally make. If you're going to get paid an extra couple $100 million to increase the share price, you're probably going to make a really tough decision.
I know,
that
but
affects hundreds of employees.
Well,
let's be honest though. Like, we've got a situation now where you're kind of forced to put a focus on getting as much as you can.
Absolutely. But that's what we said in the Stocks versus Property podcast. Lots of people in the middle class who had the factory jobs would get to a point there they'd say, listen, we're not getting ahead here, right? We're not making any money. We've got to speculate, right? And it's not a conscious thing. It's just a way of people saying, well, okay, things are really tough. How do we get ahead? And when they're seeing that everybody's buying, residential property and Nvidia shares and they're flipping them and, the neighbours have got a new Mercedes, you tend to say, well, hang on, can we do what they're doing?
Yeah, that's a good point.
Yeah, we need to.
Well, that's exactly right. We need to do it because otherwise we're not, it's died a little bit recently, but there's always this talk about, guys your age, right? Oh, you guys won't get a pension. You can't rely on a pension, right? Well, that's bullshit. There will be. But the point being is that frightens you into going, oh, man, if I'm going to be poverty-stricken, well, I need to take...
in mining stocks.
Well, yeah, junior mining stocks. But that's what people do, right? Because you get a sense of fear or desperation as in, well, hell, I'm not going to make it. And that's why, again, you're seeing a decline in the birth rate, right? Because people are not coupling up together. Why? Well, it's too expensive to have kids. I'd rather live my life and, I'll fly around the world and enjoy myself as a single person and not have, they flip it to, there's two ways to go. One way is the financial independence retire early crowd, right? They're all into, we're going to make a shitload of money before I'm 35 and knock off, right? The alternative is, well, I'm just going to work at a job. I'm not really going to have a house, so I don't care. I'm just going to go to Europe or, go to Bali every year and party in the beach for 6 weeks and, come back and do my Woolies job or, whatever it is. But you've got to make that adjustment when you get to the point of thinking, well, hang on, now I'm at a part where I may not actually make the old age and there mightn't be a pension. So, you sort of think most people would go, oh, well, I really need to knuckle down. Well, yeah, but some people go, oh, well, if that's the case, then to hell with that. And I'm going to, live my best life that I can now.
Yeah, doesn't really matter. Anyway, I'm going to bring us back on track, James.
Yes.
I want to talk about Europe's obviously released a Draghi report a couple of weeks ago in terms of EU competitiveness, and they're falling behind on the latest. Well, it's more so the investing around AI and cutting edge fields, robots, quantum computing, that kind of stuff. So they've got a few hard decisions to make in how they, I think, gain that high level of investment, particularly when they're competing with other countries like
US
America.
and China, right?
Yeah. Tough gig.
Yeah, I mean, Europe seems to be behind this.
Nice museums.
Yeah, nice buildings.
But it is quite tough for Europe. But it's predominantly, look, I could be out of line here, but it's predominantly the Germans. Because the Germans won't go into debt. So if you don't have debt, you can't have money circulating in the economy. Right? And we're going to talk about this in the next podcast special about money, but it's really important that the reason why Europe's not growing is because there's no lending and borrowing going on, because the rules are really strict about lending and borrowing, and the Germans, generally the country...
The Germans are strict. Would have thought.
Well, yeah, well, they have... The European rule is governments shouldn't exceed 3% budget deficits, right, which is not a lot. And what that does is that means that the private sector are generally responsible for growing the money pile, which means people have got to borrow. But if they're not, again, German salaries went backwards. And so, again, German people are struggling as well by going, well, there's no way to get ahead. I'll just save all my money for the pension. Right?
And then here back in Australia, the economy's not growing. And the short answer maybe is that mortgage lending's an unproductive asset.
Yes.
So,
well, it's unproductive. Yeah, it's unproductive.
The asset is unproductive.
Yes, yeah. And we talked about that. Well, if you have a look at Monday, the value of investor loans has gone up 5.5% in July. So, we're still lending,
pumping them out.
Well, we're still pumping them out.
But we can't sell the houses that are not in the inner circle of the cities. The new builds.
Yeah. But it's getting really patchy now. It's starting to get a bit patchy. But, if they keep lending money, then people will keep buying property.
Yep. And they'll keep going up.
Well, generally as a rule, yeah. But not always, because people will borrow to buy a cheaper house, right, if the price has fallen. But, yeah, someone's losing money if you buy it at $1 million, you have to sell it for 800, right? Well, someone's borrowing money, but you're still losing 200 grand, right? So, but generally it buoys the market, yeah. I had a look about 6 months ago or something, and I've tracked this for a while because, and this is, people think it's controversial. It's not. Property is an unproductive asset, right? If you buy a place for $1 million, and I come along and I say to you, Tom, I'm going to give you 1.3. Well, that's good for you, right? But it doesn't mean there's any more productivity if there's 3 people in the property, right? Whereas if I buy a machine that can make 500 cigarettes a day instead of 200, well, then I can make more money out of that machine, right? So the issue there is you get more money, but that's your extra 300 is cancelled out by me having to borrow or use another 300, right? So there's no net gain. And so if you have a look at the total lending in the figures, what you see, and this is why it's laughable in some respects, because if it's, say, well, look here, the total value of new housing loans rose 4% in July to 30 billion. Now, I can tell you that probably 20 billion of that was for people to buy existing properties, right? So, in other words, they're not building a new property. They're simply buying an existing asset. Now, all they're doing is inflating the price of that asset. That is unproductive spending. So I added it up, and roughly every year, Australia is spending about 200 billion on buying each other's existing properties, right? So that's about 1% of GDP that we are essentially wasting. Now, I'm talking in the aggregate level. I'm not talking if you go, dude, I made 400 grand. It's like, well, good for you. But I borrowed 400,000. So at the aggregate level, nothing's happened. All it is I've just paid more money, right? You got richer, but in some ways I got poorer by 400,000.
Oh, the bank wins.
Yeah, I see what you're saying.
Yeah, bank always wins.
Yeah.
But my point being, we're spending a lot of money, 1% of GDP, on unproductive assets, right? And this is why it's important, because people are seeing property as an investment vehicle, right? And that's why we talked about it in stocks versus property, because once you talk about investing in property, then you have to look at it differently from, I'm buying a home, I'm going to quote, unquote, buy and hold for 40 years, right? Which is what my parents did. They didn't look at property and go, we'll be able to flip this sucker in 5 years and, move up and then do it again, blah, blah, blah. But when you look at that, it's completely different to buying an asset going, this is our home. I'm going to work at the factory, I'm going to drop dead in 65, look after the kids, grandkids, blah, blah. It's completely different once you say there's a group mentality of we're all flipping and buying houses. Then you really get some serious winners and losers.
Yeah. I mean, it's safe to say there's a culture of, you need to get in. Need to get in the market. It's only going to go up.
Yeah.
We've probably had this conversation 20 times on the podcast, I'm sure.
Well, it's in Tuesday, right? The current difficulties housing policy partially stem from the explosion of mortgage debt.
Yeah.
We've engineered a price for housing that will cause a severe problem for future generations. That's the central point I'm trying to get across to people. Some people will win, no argument at all, right? But there's going to be some losers. And the longer the cycle goes on, the more losers there will be.
Well, yeah,
Right?
it comes back to logic. If it continues at this rate and people are adding properties to their investment portfolio at current valuations, rents are going to have to go up, and it's just this absolute snowball where everything becomes more and more unsustainable. And if people are going to argue that property is only going to continue to rise, okay, so 30 years' time, are you telling me that the average house is going to cost us $2 or $3 million.
Well, 4 or 5 at the rate they're going.
Yeah. But you know what I'm
Well,
saying?
some
Like,
people will say yes.
and it's just like, okay, so just tell me how that plays out.
Well, that's
for most people.
Yeah, but that's exactly the point. When you step back and look at an investment rationally, and you say to yourself, okay, what's the historical return? Right? Where are we in the cycle? And as I say, I do this with stocks. Right? US stocks are crazy. Right? Cape ratio, which we talk about on Wednesday, is like 35. The return over 10 years is like 2%. Well, inflation's going to be running at 3 or 4, so you're going backwards. Now, will some people make money? 100%. But I'm talking about the aggregate. And what I'm trying to say to a lot of people is just make sure you're not on the bottom 5%, right, where you're one of the losers. Because when you invest, there's a dynamic, as we said in the stocks and property, not everybody can win, right? At some point when the cycle turns, somebody holding that property or that stock goes, well, hang on, why isn't it going up anymore? And it's like, because you bought it at the market top.
Well, that's how markets work, right? It's not exclusive to property or
Exactly.
stocks.
It's bonds,
Artwork.
Bitcoin, NFTs, those, silly bloody things people bought. That's the way it works.
Cars.
Right? Cars.
I remember I sold my Mustang a couple of years ago for more than I bought it for.
In COVID.
Totally lucky. Bought it for X, put 70,000 Ks on it, sold it for Y, about 10,000 more than I bought it. And then about 6 or 8 months later, the guy sold it for about 15K less than he bought it from me.
Perfect. That's a absolute.
Cha-ching.
Yeah. But that's what I mean. You would be foolish if you went, man, I'm going to be a car dealer.
Yeah.
It's like, no.
The funny thing was, he was a car dealer.
There you go.
You just wanted the range, mate.
I just wanted the range.
See, I bought a new farm property for $175,000 in 2000, maybe 2001. The guy who I bought it off was a mining executive who paid $187,500 for it. So in other words, he held it for like I think he had it for 2 or 3 years. He lost money. He sold it to me for $175,000, and I sold it 5 years later for $326,000. So I made $15,000 a year. He made -3 or whatever.
That'd be worth $17 million now, Steve.
If I'd have kept it, I'd have
Timing the
been
market.
Yeah. Yep. But you're right, Tom. If I'd have kept it, I looked at it. I sold it for $326,000, and I looked at it like 5 years later. The guy who bought it off me flipped it for $550,000, I think, or something. So I calculated I'd have made basically 15% per year. That was the last time I looked at it. But now it'd probably be...
That's early 2000s.
Yep. Now it'd probably be... conservatively, I'd say it'd be worth $750,000 because it had city... It had city... When I bought it, it had sort of glimpses.
More than that.
Mate, you won't get a tent for that.
Well,
in
yeah,
Newmarket.
probably.
Is it Newmarket or New Farm?
New Farm.
New Farm.
Mate.
Yeah,
It's right in the hub there. It's a fantastic spot. But like Jacob, I bought there because, my friends were there and it was like, oh, yeah, it looks like a good place.
Yeah.
Went to the bank, can I have some money? Sure. Okay, cool. And away I went.
Lovely area. All right, Wednesday, high cap ratio. The interesting thing for me, and I remember to put the chart up, fellas, before you shout at me.
Thank you.
Is that we are in the lower percentile there of about 2-3%. In the 10-year projected returns with a cape this high. So what we're trying to say is, if you're investing in the US market now and you're going all in, or even if you are dollar cost averaging in and you're buying a bit every now and again, you expect, just because it's delivered 11% year on year or
about
more,
14 since 2009.
Since 2009 does not mean the next 10 years are going to deliver the same returns.
Yeah.
And in fact, inflation is probably going to eat away at it.
Yes.
Well, that's the point, right? It's just extremely overvalued right now. Projected returns are down. It's not to say it won't go up, but not financial advice.
If you have a look if you have a look on the right hand side there where it says March 2000, -2% annualized. Right now, in March 2000, the cape was 44. At the moment, I didn't look at it this week, but I think it's about 35 or 36.
Yeah, but Steve, it's always
It's always going to go up.
If you look at it from left to right on a chart, it's always gone up.
If you invested in 1880, you'd be worth a monster.
Mate, .com was a black swan, mate.
Yeah, I know.
It had nothing to do with
So was the
valuation.
GFC. The GFC was a black swan.
Nothing to do with valuations.
Nothing to
All right.
do with it at all.
You
Righto,
put
be
'em
on
away.
Thursday already.
All right, yeah, we're just kind of echoing the same thing. We think the ASX is a little overvalued, but nothing like the overvaluation we see in the US,
Keeps like
which is
20
why
or
we
something.
keep going on about it.
We need to goddamn spend some money.
Yeah, which what we've been talking about.
I'll call
Well,
Chalmers.
One of the things that I find a bit amusing is people, and back to my favourite group, the economists, saying, "Oh, the government's spending a lot of money." Bullshit! They're spending hardly any. This stuff about the government's being profligate and spending money. It's like, dude, we got economic growth of like 0.9 and it's falling. If the government now let's compare us here where we're spending 1% of GDP, right, which is miserable. In the United States, they're spending about 6.5 or 7. The place is going absolutely gangbusters, right? Wages are rising, investments booming, house prices are getting a kick along, the stock market's going crazy. Meanwhile, over here, Albo won't loosen the purse strings, and we've got economic growth at 0.9. Right.
Are we doing? Why? I mean, why are we expecting a trickle down from the US or something?
No, it's because these stupid economists here don't realise the value of government deficits, right? And the US just shows that. In COVID and in Australia, when we said, right, let's throw a shitload of money at people, what happened? Well, bugger me, the bloody place went gangbusters. Well, hello. That's what happens when you give people a lot of money. And that's why I say, you raise wages, what do people do? They
Spend
go
money.
they go and spend it.
Thanks for that, though. When they did that, now I can't buy a house. So,
Well,
you
no. That's a misconception. Again, that's a misconception.
Don't get him started.
Didn't help me that
Oh
much.
my God,
That was planted just to rile Steve up.
Yeah.
that's the next property podcast. But it
Sorry, Steve.
I know what you mean. But it's my point of saying somebody's got to spend money to drive the economy. If you say, government deficits are really bad, okay, well, it's left to people to borrow. And what do, Tom? They don't borrow to buy bloody Doritos. They borrow to buy a house. Why? Because they're speculating. Because they're not getting wage rises. Right? That's the way it works. When the government's spending and it's building lots of infrastructure and all sorts of stuff, people's wages generally rise, or they at least say, hey, I'm feeling pretty secure, things are pretty good, I'm rolling along. But when it gets as it has been in the last 40 years, where it gets tough for more and more people, you have to really look at that and say, how can we fix it? Well, Joe Biden showed you how you fix it. Spend an absolute mozza of money, right? And the government can't run out of money, right? It's their money, right? It's not as if they're going, oh, geez, oh, shit, we've got no more $100 notes
Yeah,
left.
Australian
Oh.
dollars. Yeah.
Honestly, it's so, you just look at it and go, oh my God, it's just crazy. Don't get me started. Righto, what are we on, Friday?
We're almost at the end, mate.
Oh,
no, yeah.
it's China again.
Oh no, skip
So,
it.
all right, that was just for Chris.
Yeah.
No, look, we believe China's in a serious transition period where it's going to need to make a decision, like Japan had to do back in the 80s and early 90s.
Yep.
Debt levels very high enough to make consumption growth very difficult for them.
Yep.
Which
They're
is the short version, right?
They are Japan.
Well, yeah. I don't think they're going to do US and just capitulate in a year or two. They'll drag it out.
Well, they're different style of government.
Different morals as well, and just how they.
Well, yeah, Xi doesn't like consumption, right? He doesn't. He thinks that's awful, and we've said that before. What I'm trying to point out to people here is, and we're recording this on September the 21st. This week, as in the week just past, they're now talking about trying to help the property market more, right? But this is what you get. You get to the point where you can't help it, right? Because you can't force people to borrow money to prop up an idiot who paid 13 times income, right? Because that means you're going to pay 13 times income, right? So why the hell would you go, and when the rose-coloured glasses come off and you go, hang on a second, it was $1 million, now it's 900. Well, why would I rush in? It'll probably be 800 in a year, right? This is how the cycle turns. But what we're trying to say to people is, look, don't rely on governments to save the investment, because if they do, you end up with Japan where it bleeds for 30 years. That's your choice. If someone says, look, dude, you bought a property for $1 million, it's worth 700. That's it. No one's giving you anything more than 700. Well, if you've got it there for $1 million, well, best of luck trying to flog it for, $1 million or 1.1 or 900 when everyone's going, but it's worth 700. Right? Because everybody sobers up.
Especially if there's no wage rises as well, Toff.
Exactly. That's why I say Albo's not going to be ringing you and saying, listen, Tom, I'll take I'll take the property off your hands. They may do, but it's, the renters wouldn't be too happy when Albo bails out the property investors, because what that means is, oh, well, hang on. So, in other words, I just risk up myself and then Albo comes in and saves me.
Yeah.
Right?
He's not spending, so.
Sorry?
He's not spending, so.
Well, he's selling his investment property.
Oh, is he?
Yeah, 1.4, mate. Only one of the 4 properties that he's got.
So he's offloading it before he
He's
lets
at
it
the
all
top,
fall, mate.
He's been listening to Total Money Management.
Imagine.
Love your work, Albo. Spend some money.
Bonus section. Some pictures don't need explanation.
Yeah. So we're not going to explain.
We're just gonna move on.
Would you mind? I mean, this is a standard deviation.
I'm just showing the regression channel, right? Which means it goes up to a point and then it falls down. And the point I'm trying to make to people is, see the blue line that goes up and then it's followed by the red line that goes down. Right. Now, the first red line's minus 60%. The second red line's minus 68, minus 61, 61 and 27. What I'm saying is, when the market turns...
This is the S&P, by the way.
Yeah, yes, thank you. What I'm saying is, when you make 100%, and you're going, woohoo, this is really great, right? Well, let me use a current example, right? March 2009, imagine, by some miraculous thing you put in 100,000, right? So it's gone up about 13% compound per year. Here we are in, say, 2025, right? Your 100's turned into 450. You're a genius. Now, if I say to you, well, listen, Tom, every time it's been up that far, it's lost 50%. Your 450 goes to 250.
Yeah.
Now you look at it and say, oh, geez, I should have bloody well sold, or sold a lot of it when it was at, 2024 when the Cape was at 35.
And then reinvested in.
And then reinvested again through the cycle.
But what most people will do, if that happens to them, is sell when it's around 250 because they don't want it to go to 100, and then they'll buy back again when it's at 350.
Yeah, probably. But that's how you get the average return, right? You get the above average performance, which we've had for the last 15 years.
Yeah.
But remember, from March 2000 to 2010, you made nothing, right? And in actual fact, you lost money. And that's why I'm saying you've got to think about those market cycles, right? Because the further away, the more irrationally exuberant you get, the worse the return is at some stage. Now, I don't know whether it's going to be, it could start on Monday for all I know. But what I'm saying is at that level, and you look at that chart, if I said to you at the top of that blue part, Tom, listen, Tom, great idea, get into stocks. You'd be looking at it going, gee, Steve, those red bits are a bit damaging. Nah, mate, you'll be right long term.
Just look at it from 1870.
But yeah, that's what I mean. Yeah, what's the return?
For another 100 years.
Yeah, 8%. You'll be right, mate. But that's my. You see what I mean? It's really, really critical that people understand about valuation, and that we're saying they don't just go up all the time, right?
Yeah, they just go up most of the time.
Yeah, but watch out when they fall.
Yes.
And we got a little bit of a grasp on when they fall. We don't know that it's going to be Monday at 2:30, but all we're saying is, look, over this 12 months, they might go up 20%, but in the next 12 or 24 months, they could still go up. But at some point, they're going to fall because that's the way the market cycles work. And that's when people go, oh, no, Albo won't let it fall. It's like, okay, all right, off you go. You know, the same thing with stocks. Oh, everything looks really good. Okay, but it's, you know,
Till it doesn't.
Well, there's been periods when the economy's really strong and stocks have gone nowhere. And Warren Buffett pointed this out in a letter on one of his letters on valuation, I think, where he said, you know, you look at the Dow Jones index, from 66 to 82, it went up 2 points, right? 2 points. Company earnings went up like 7% or something, right? And if you look at 82 to 2000, stocks absolutely killed it. Earnings weren't that good, right? Why? Because it was valuation, right? In 82, the Cape ratio was like 5. And in 1966, it was like 27, right? That's why I say, if you look at that and you get to understand it, you can see, yeah, the economy's doing really well, but that doesn't necessarily mean stocks are going to do well, right? That's where it's a little bit tricky.
All right, short story. Steve's been up to his old tricks again, where he's just been posting random articles with no context. So it's up to, we've got to guess what this is about.
All right.
Keep you on your toes.
So predicting staff shortages in schools due
normal.
to staff burnout. So
normal.
that's driving teachers out. The headline of the article is a quote from a teacher saying it's basically having no life. China's property stocks are back to 2008 lows. I don't know. Does that mean I should go get a house in China? It's probably more affordable.
No, but I'm just
They probably
pointing
won't
out.
let me.
Imagine in 2000. Look at 2019,
Yeah, shit.
right? And I come to you and go, "Oh, Chinese property stocks look expensive." You go, "What would you know what you're talking about?"
Someone's
And
holding
look
it
over
back.
the next 5 years, zoom down the elevator.
Someone's holding the bag from 2019, aren't they?
Plenty of them are. Personal insolvencies are
Yes.
Predicted to surge this year
yes.
as more and more households have to use their savings to pay debt.
Oh, we all know how good they are at predicting things, though.
Yeah, well, that's the thing. Yeah, that's
Rates
the,
are not going up. Remember? What about the chow? I think I reinflate. Oh, it did. Yeah.
Yeah, so this is just talking about defensive sectors, or the ETF market share for defensive sectors, and it's a pretty good story, I think, for
Yeah.
if you not obviously not financial advice, but if you're looking in that area.
It's
lowest
sort
in
of-
20 years.
When you look at growth stocks versus value stocks, growth stocks have had a spectacular run since 2009, and value stocks have been awful. Well, I shouldn't say that. They haven't been awful. They just haven't been as good as growth stocks, right? But the way it's moving, value looks to be coming back into business, and they generally do when the valuation, the cape is high, because everybody wants to buy NVIDIA, right? Everyone wants to buy NVIDIA and semiconductor stocks, and man, why do I want to buy those boring old utilities that pump out an 8% dividend if I can buy NVIDIA and make 30% in a week?
But when the cape's high and the market's become a little bit more tentative whether they're going to get into those growth stocks, an 8% dividend looks fantastic.
Yeah, well, when the market collapses and you go, man,
Still
I
getting
I want to
8%.
get a dividend at least. You look at something that's been around for 100 years and go, bingo, that's where at least I'm getting 7% or 6 or whatever as a dividend.
Yeah. That's a good chart.
Ding, ding, ding.
We're done. Thank you,
All right.
gentlemen. Good to see you both. And for those that want to reach out and ask any questions, you can reach us out via the socials or support@totalmoneymanagement.com.au email. Until next time. Cheers.
Absolutely.
Cheers,
and just
folks.
real quick, anyone that's listening for the first time and doesn't know what we're talking about, jump on the website, subscribe to The Week That Was. You'll see what we're talking to, all the pictures, articles mentioned in here. So, cheers.
Perfect. Thanks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.